this is such a critical time for investors around the world trying to understand what's going on. We've got the US markets, pretty much back to where they were. My question to you first, Peter, is are the markets overvalued?
Well, absolutely. I mean, the US market is a bubble. I mean, so it's not just overvalued. The valuations are extreme. So the bear market that's going to follow this bubble when it pops is going to be particularly vicious. The problem is it may be harder to detect the magnitude of the decline if you're measuring it in US dollars. But if you're measuring it, let's say in Australian dollars, that's where you'll see a much bigger decline. Of course, the biggest decline of all will be if you're pricing US stocks in terms of real money, which would be gold. And I would expect to see major US stock markets lose 80 to 90% of their value from here if you price them in gold.
Let me just come back to gold for a second, because obviously a number of central banks around the world have been acquiring gold. And in fact, many other people, even in some Asian countries particularly. What do you think is there a sort of a drift away from the US dollar?
Oh, absolutely. I mean, right now it's a drift, but it's going to gather momentum. I mean, the smart central banks are buying. But what I think we are headed for is a remonetization of gold. The U.S. took the world off the gold standard with Bretton Woods. But then we broke our commitment to the world in 1971 by defaulting on gold backing. The US dollar never would have been accepted as the world reserve currency, but for its convertibility into gold. That's what made the dollar as good as gold. So I think the next step, now that we have so massively abused the privilege that the world has given us, I think the next step is for the world to go off the dollar standard and back to the gold standard, which is the standard it was on prior to Bretton Woods, because currencies need to be backed by something. So when currencies were backed by gold, they were backed by something real. When currencies that were backed by the dollar that was backed by gold, they were still backed by something real. Through the dollar, the world was still on the gold standard. But now you have currencies backed by dollars that are backed by nothing. So if you back your currency with something that's backed by nothing, then you've got no backing to your currency. And this is the problem with the modern monetary system, is there's no real anchor. There's no real value to the money. And so it can just be created at will, and you have the potential for a loss of confidence, which is where we're headed. So I think the world remonetizes gold. And in order to do that, the price of gold is going to have to rise substantially from its current levels. Otherwise, the only way it's possible is if the price of everything else collapses. And I think that's less likely than the price of gold rising to where it would need to be given the current level of prices for other assets and consumer goods. And of course, it's a moving target because it depends on when the remonetization occurs, because between now and then, a lot more fiat currency can be created. And so really what gold is doing, gold's not going up. It's just letting you know how much value all these fiat currencies are losing. And so the more they print, right, the more unit of each currency would then be required to buy an ounce of gold, because the global supply of gold doesn't really change very much. I mean, it grows slightly on a year-over-year basis, but money supply can just grow exponentially. So if they just keep printing more money, well, that doesn't mean there's any more gold. So now all that gold just has to, go to more and more money. And so the price of gold just has to go up for the market to clear.
I'm obviously fascinated by this deflation, inflation debate, because it really is quite fundamental, isn't it, in terms of how you think about asset allocations and where you actually make investment decisions.
Yeah, and Harry and I have been arguing about this for quite some time. And obviously the price of gold continues to rise, despite Harry's belief that it's going to crash. But, Harry and I agree that we have a massive bubble, and that the problem is, too much debt inspired by the Fed. And the way Harry sees this resolving is with everything crashing down and the dollar going way up. And to me, that makes no sense, because I know that the Fed is going to keep printing dollars to try to prevent asset prices from crashing. I mean, that's what they've always done, and they're going to keep doing that. And there's nothing to stop them from doing that. And so I think that Harry's got it wrong. I do think that you're going to see a massive deflation of the asset bubbles, but not in terms of US currency, in terms of real money. So if you want to think about gold, yes, the price of stocks and real estate and everything else are going to come crashing down in terms of gold, but not in terms of paper money, because paper money will lose value even faster than those assets, because assets have some value. Even if they're overpriced, there is still some fundamental value behind these assets. There's no fundamental value at all behind paper money. Paper money can go to zero because that's the intrinsic value. But property isn't going to go to zero. It's worth something. A lot of these stocks, they're viable businesses. They're not going to be worth nothing. I do think they'll be worth less in terms of gold than they're worth now, but they could be worth a lot more in terms of paper because it's all relative. Yes, asset prices can go down, but if paper money value goes down even faster, well then in terms of the paper money, the assets are going up. So Harry, I think, is just looking at the wrong thing. He looks back at the 1930s and expects a similar, movement. But Harry forgets that during the 1930s, we were on a gold standard. The dollar was backed by gold. So when the dollar gained value, it was because we were still on a gold standard. And so prices went down during the Great Depression in terms of dollars because the dollar was gold. It's not gold anymore. It's just a piece of paper. This is not the 1930s, and we're just going to keep on printing. So the real crisis is going to be a currency crisis because the Federal Reserve is going to keep printing money to prop up assets and prop up the US government until the dollar crashes, because that's the only thing that's going to put a stop to all the money printing and the spending. So we're headed for a US dollar crisis, and we're headed for a sovereign debt crisis. Harry is hiding out in US treasuries. As far as I'm concerned, that's the epicenter of the explosion. I want to be as far away from US treasuries as possible. And I think the opposite of the dollar is now gold, right? Gold is the epitome of fiat, and gold is real money. And so that's what's competing. And I think gold is going to win, not the US dollar. And so I feel bad for people that are following Harry's advice because they're right to be worried and see a crisis coming, but they're wrong in thinking that they're going to have refuge in the US dollar. They're going to lose even more money there than if they stayed in the US stock market. But I think they would do even better if they followed my advice to get out of US stocks and bonds completely, go to international equities, value stocks, dividend paying stocks, mining stocks, commodities, raw materials, things like that. I think I'm building the portfolio that is going to not only survive the crisis, but thrive